If somebody does not have skin in the game, then they don't think as owners. And I'm an owner. I like to go at the sector the most aggressively in times like today because things are very, very cheap and they will not last. If we're dealing with exploration companies, they are high risk, high reward. As long as you get some of your moonshots in there, you can have world-class returns in any year.
Welcome to How to Invest in the Minefield, and today I'm going to be talking to Eric about how he maps out his investment ideas in this space. He's going to take us through some of the things that he actually owns, so things he has skin in the game, so do with that what you will. But he'll talk about what are the boxes he likes to tick to make these investments. Some of them are going to be relatively large cap, over $1 billion, but some of them will be little tiddlers at $50 million or less. And he's also going to have a little teaser in the crypto space at the very end, because we will be talking about the crypto space over coming weeks. And given that policy can be the driver of gold, technology stocks, and crypto, there is a reason that he cares about that space as well as the miners. But predominantly, we're going to be looking at gold miners and silver miners, and what are the things that rocks Eric's boat when it comes to looking at some of these names. We're actually going to be naming some names today, or looking at some specific names. So once again, I just want to reiterate that what you're seeing is for engagement and entertainment purposes and educational purposes. It's not investment advice. Everyone should have their own risk tolerance limits, their own goals for investing, and should do their own research. But with that said, firstly, welcome, Eric.
Thanks, Roger. I'm ready to rock and roll.
In, I think, the episode from the 3rd of December, you actually laid out your framework for investing in some of these names, how you enter them, how you manage them, etc. And you talked about a whole range. You talk about this range of size, and we talked about liquidity from the itty bitty teeny ones, super high octane, all the way through to what some people might think are quite mundane, but I don't think you do mundane, which are the larger cap ones. Obviously, you've got a vested interest in some of these names, so we've got to be very clear about that. And also, I think, in terms of these, we've talked about how people should think about these in their portfolios. These should be a small part of most people's portfolios, that little bit of, almost optionality. So, people need to be aware of that. Now, what I'd love to understand is, you talk about a framework. What are the things that you're looking at? What is it that floats Eric's boat, as it were, when it comes to these mining names?
I like the fact that we're almost 3.5 years into a bear market cycle that has decimated these names, while many other areas within the market, including the S&P and the Dow and, QQQ and all the major tech stocks, have not done anywhere nearly as poorly. The bear market in mining stocks started right around August of 2020. The worst of it has been in the last 12 months. And now, especially with a crescendo of tax loss selling season that has created disconnects in valuation from a couple of different standpoints. The earnings per share regular PE multiples for the producers is on the lower end for sure. But what you're also looking at, if you go under the hood, it's about the net asset value of the assets that these companies have drilled and found, developed, and moved forward and expanded for decades in many cases. And they've got a certain amount of money in the ground, gold or silver that's in the ground that is conceivably a good portion of that will come out in the future. So there's a net asset value component that is extremely discounted throughout the space. But if you go the lower you go into the market capitalization, the more whacked out it is. This is an area where you can make 10, 20, 50 times your money if you're correct, if the timing is right. And then the big one that tends to really drive returns like that for companies that are in the worst business in the world, or the second worst besides the movie business, because all they're doing is raising money, diluting, and then going to try to drill and find something and then develop that one day will be a mine, but there's no revenue. There's no revenue on the horizon. This is what, gold and silver investors know about. And one thing that changes everything for any of these companies is a new discovery. So we have identified many different companies that are successfully drilling recently, and some of these companies that have been drilling even over multiple corporations that, maybe gave up in the 80s, and then the asset is there. Somebody buys it out of BK. They work on it for a decade. They come into a very bad market. They give it up or they puke it out because they've got something else they're more excited about. And you're seeing decades of development in these assets that have real value in the ground. Third parties that come in and say, hey, you've got, 1 million, 3 million ounces of gold in the ground at this grade on your 43-101 and this category, or you've done a preliminary economic assessment or pre-feasibility study, which is when you get into the late stages of deciding whether or not you're going to actually start a mine. So all of these components are taken into consideration, and I like to go at the sector the most aggressively in times like today because things are very, very cheap and they will not last.
It sounds like there, almost if I can mix up my manufacturers, that you sort of get your Dyson and hoover these things up, sweep them all up in one go. One of the big things I get is skepticism towards management. They see that the management of many of these companies have destroyed value over time. What are maybe 2 or 3 things, just as ideas for people when they're thinking about this space? What should they look at? What are your big red flags? And what are your big blue sky kind of opportunity things that you look for?
The comment you just made about management having sort of a value destruction habit. This is actually a very big problem in the mining space. You have a lot of different small companies that actually amazes me. We were going to invest in a private placement in a small deal that has a very interesting asset in Nevada, a gold asset, but the level of drama between the board and management over like this $6 million market cap company with like $20 in the bank is incredible. And this happens a lot. Most of the different ideas that I'll bring to the table are going to be driven by superstar operators. The reason that we're in them are because they are run by gentlemen or women that have had multi-billion-dollar winners over and over and over, or at least, have a track record of that, because it is extremely important. There is a level of ineptness in the world, and it seemed to also be concentrated in the junior mining business as well. So it's definitely something that has to be consciously looked at. Now, I'm not a perfectionist in this area because everybody has some level of weakness or flaws. A lot of these companies are run by geologists that are, a CEO of a company, and they're just not that familiar, or they got familiar over trial by fire about the streets and finance and capital markets and how do you end up interacting with your investors. It's not necessarily natural for them. Then you have the guys that are slick talkers and they know the finance side, and they're hucksters. And, you got to be careful about that. There's an over dilution problem in the sector for a lot of these small companies. If somebody does not have skin in the game, then they don't think as owners. And I'm an owner. We come in this stuff as owners of these businesses. So I am, number one, my main thing in terms of how do I vet these deals, I look at the capital structure. And I look at the pattern of the company's CEO and what the board ends up rubber stamping in terms of how much money are you going to raise, like especially in an environment like now. So I'll target some of these companies that have had the underperformance, that have had to roll back their shares after, years of what we call Vancouver lifestyle companies or CEOs. Some of these guys end up, they take a salary from 3 different deals. They've got no stock in any of them, and they're just making their living, and they go eat steak dinners and go to the hot spot in town every Friday and Saturday night, and they're happy with that. I'm not. I am ruthless with these guys when it comes to them, having stuff that they're doing that is wasting money, that is ruining our capital structure, which will ruin our returns and our return profile. So on the small end of the market, that's a big part of it. On the larger end of the market, it's about what is the market missing in terms of, say, for example, the discounts to net asset value. A low number of earnings. Are there going to be catalysts in the future that could be a new mine coming online in 6 to 12 months? And they've already spent 96% of the CapEx and 90% of the build on their biggest mine yet out of 7 mines is coming online. And so the biggest returns in mining companies happen if you invest early in a discovery phase. A junior miner actually hits and finds a new gold, silver deposit that's got good grades. It looks like it's good size. And then they keep going out and then they keep showing that they're hitting more and more and expanding that asset. That is usually the where the big juice comes in for the exploration companies. But then you have that period, but then you've got a big resource and an asset that you have to start doing the work on the economics of a mine. So it starts to roll over and you've got to do all these economic studies and then look at the fact that if you're going to put it into production, the capital expenditures are usually in the hundreds of millions or billions of dollars. And so you've got to raise all that money. So then the stock ends up having a period of underperformance, even if over, say, a decade, it's a darling of the street because they discover a new asset that's really attractive. They have to go and build it. I will look at when they're going into production or after they've gone in, or maybe a little bit before, if there's a combination of a discount to net asset value, they've got other assets that I like, and they are about to go into production and it looks like with no problems. A lot of these projects are overrun on cost and on time, as I'm sure you can imagine. It's a very difficult business. But those are some of the frameworks that I look for to make sure that we're, we have the odds in our favor to make actual money.
So I think a couple of important points there, which is, we talk about these are vested interests that you have, but at the same time, you're kind of acting like an owner mentality, working with people who you trust. You've got skin in the game, so these are things that you believe in, but presumably you had a diversified portfolio as well, so they'd not hurt you.
If you put, whether it's, $1 million in 10 deals or $100,000 in 10 deals or $10,000 in 10 deals, same amount in each one. And it's not $1 million if you're going way down to the very high risk, high beta type of opportunities. But the point was, you can have 5 of them go to zero and, one of them down 50%. But then you're going to have one of them that's up 50, one of them that doubled, and one of them that, can 10 or 20x. And that's typically what happens, but without the 5 going to zero. They could go effectively to zero, meaning like they just survive, but it's trading, we got in at 25 cents and it's at, 3 cents or something, and they're on life support. I would call that like an actual wash. But the point is it's a venture capital model. It doesn't matter as long as you nail it on some of the plays. And a lot of times, even the best VCs in the world that I've worked with out of Silicon Valley, they say, we don't know, we know the best frameworks to put this stuff in, what works and what doesn't. We don't know which one's going to take off first or maybe the most. That's where I love the variation from the drill bit, because the drill bit can change everything. You look at an industry that generally is filled with more disappointment from hype than it is with, wow, we just found a new, multi-billion-dollar ounce per ton gold deposit in Nevada. Those happen. And that's where you see, we had 2 years ago, a company called Great Bear. I think it was 5 cents or something. One of my elite members was a big owner of the Shell Corporation. I think it was 5 or 10 cents Canadian. It got bought out at like $25 within like 2.5 years from their discovery. You want to talk about a life-changing game. So not that that's going to happen and that is an extraordinary outcome in the plays, but the point was being that if we're dealing with exploration companies, they are high risk, high reward. As long as you get some of your moonshots in there, you could have world-class returns in any year.
Let's just turn to some of these names that you like and what sort of got you interested in them. And again, let's just reiterate, these are things you've got an interest in, but you've got to talk about them because you're going to talk about why you like them. Let's go down the scale. Let's start at large cap, accessible to most, even with deep pockets, and then go down to the teeny caps where, a couple of grand is probably a big investment. What's that largest cap one you were talking about and what was interesting about it?
So I believe that the generalist investor is actually going to come into this mining sector more than we've ever seen before at some point in the future. And maybe people think I'm nuts, but I'm I'm very confident in that. So let's look at one that you could kick the tires on and start to get, your feet wet, if you like, with I believe it's 1.5 or 1.6 billion as of last night, which is Equinox Gold. EQX is the symbol on the New York and also the Toronto. So the reason I really like Equinox there's just several bullet points I'll give you. Number one, largest shareholder, Ross Beatty, Beaty. He's one of the top 5 operators in history, in my mind, in terms of wealth creation from company to company to company that he starts, builds, sells. Equinox is a very later stage in that regard. In 2018, this is, from my awareness, this is the fastest growing gold producer that is now becoming a major gold producer that we've had in the market in the last 5 years. For example, they produced 25,000 ounces of gold in 2018 when they were a very, newer company going into production. This year, they'll produce 600,000 ounces of gold, and they have a very clear path to get over 1 million a year in the next 2 years. So not only does the company right now trade at a price per NAV of 0.6 to 0.63 recently, where senior producers, Barrick, Newmont, companies of that nature, right now trade for, on average, 1.1 times NAV, okay? So you have a potentially a double just for a valuation appropriation and normalization in Equinox as they get to the 1 million ounces a year of production, which would then, in my mind, qualify them as, a senior producer. And the Greenstone asset, this is in Canada. So they have 7 different operating mines in 4 different countries. 3 of them are in Brazil, which I'm fine with in terms of geopolitical risk. Greenstone is projected to be 400,000 ounces a year in production, and this is going to go into production in Q1 next year. So they own it 60-40 with a company. It's a finance company called Orion. So you would only take 225,000 ounces of that, which is substantial, and add that on to their 600,000 ounces. So you're talking about somewhere in the ballpark of 35% growth in production. Their cost profile, all-in sustaining costs, after spending all this money on CapEx to build this mine, this is a company that's going to be highly profitable. They've been streamlining their other mines already after this process that you have to go through. And they're expanding 3 of their other mines, which is going to be why they will be, it looks like, give or take, it's going to be 1 million ounces of gold a year in production starting in 2025. And that's not small. They've got 17 million ounces of gold reserves as well. So, you do the math on that, and that's where you can also bring in your numbers on the net asset value. So this is both a cash flow and growth play. I love Equinox Gold because of who's running it, who's behind it, who are the major shareholders. This is a proven entity, and it's a very strong idea that has not traded up yet to where some of the other senior producers have for a relative valuation, and that includes even if gold stays at 1,900, 2,000.
That was a 1.5 billion company. Next one up is, did you say 600? 600 to a billion? Is that
500 million? And it actually, so by the way, Equinox has 350 million in cash on the books and 110 million in investments. Healthy balance sheet. Part of the investment portfolio is the next company that was spun out from Equinox Gold called I-80. IAUX in the States, IAU on the Toronto Stock Exchange. This is one of the largest gold silver resource holders in terms of assets in Nevada. They're number 2, and they're looking to become one of the top gold producers in North America within 5 years. And I think that they're going to be able to pull it off. So for example, one mine is beginning production within months. This is going to be their first mine that's in Nevada. Another thing to consider, geography and geopolitics. There really isn't a better place to bet on a mining company, building a company anywhere in the world versus Nevada. Nevada is mining, and mining is Nevada. It is the friendliest state, and it actually produces more gold than any nation in the world, just in the state of Nevada. I-80's got 3 different mines that are in permitting and development. So they're basically moving forward 4 projects at lightning speed. What you've got, though, are very high-grade open pit targets for Ruby Hill, which is 0.71 grams per ton. Granite Creek is 1.38 grams per ton. And Lone Tree is 1.77 grams per ton. For open pit heap leach projects, this is very high-grade stuff. What does that mean? Profitability, baby. I mean, that's exactly what it will come down to. This is not very low-grade stuff.
So how does that compare? Because you said these are good. So yeah, I think you went from 0.7 something up to 1.7 or so. What would be normal? What's the kind of bog standard average on that sort of grade?
Well, in Nevada, you'd be looking at half a gram to a gram. I think it's something where, you could even have less than that. So we're looking at Ruby Hill is the one that's in the middle of that range. The 1.38 and 1.77 are in the top, probably 10 to 15 percentile, I would imagine, that will be in Nevada. Underground is off the charts high grade. We've got, with Ruby, 6 grams per ton, granite, 10 grams per ton, and Cove is another asset they have, which is 11 grams per ton gold. So that they've also got 200 million plus ounces of silver in their cache, and that is growing. But I-80 is one of these deals that is exceptionally well run. There are substantial deposits of gold and gold mines all around this area. It is extremely prolific, and they are already on the move. They acquired the company Paycor right below them to start consolidating this trend. I think I-80 is one of these plays that, it's not in production yet, but it's about to be in production, and it's going to be a rapid fire. And these guys have always come in at or under budget. Their timelines are on point. It is an exceptionally well-run company. It was spun out of Equinox with best practices. It could easily become an Equinox. And I'm not talking about something in 10 years. I'm talking about in the next, 18 to 24 months would be my guess.
And so then next up, are we now going to look at a stock in the silver space?
Yeah, so I'd like to share one that I don't think a lot of people know about. And it's just it's a very attractive overall story. Symbol is SVM. It's called Silver Corp Metals. And this is a pure play on silver. These guys have been active with a buyback of stock. They just started a twice-a-year dividend. They're on an acquisition tear. These are not massive acquisitions, but they are modest acquisitions. Silvercorp is trading around $500 million, a little bit less than that on the market side of things. But what's really interesting here, too, is that they've got, $500 million on the market cap. They've got $150 million in cash and investments that are on the books. Their last quarter, they cash flowed $28 million. They earned 7 cents a share on the net income side. They're very nicely profitable. They're going to be completely, I think, showered with additional cash flow leverage if and when we see that silver price go higher and follow gold, which it inevitably tends to do. But with non-active assets, which are the properties they have, the plants, additional investments, $680 million if you go look at their recent CDR. So, that's like right now you've got $800 million in change US in cash investments and assets and equipment for a company trading at less than $500 million. And is doing about $200 to $250 million in annual revenue. So It's not tiny. It is a good-sized mid-tier silver producer with growth prospects on the act. I really like the activity that they've been showing in acquiring some of these very cheap assets and companies that are out there. They're in the middle of 2 deals right now, but they're sort of like in that 20 million range, so they're very easy for them to swallow. But it's very important. And if you look at, the two really one of the main important things with any of the metals is to look at what is the company's all-in sustaining cost, AISC, as it pertains to whatever metal that they are producing. You also have other metals and minerals that are usually in these deposits that act as credits to bring that all-in sustaining cost down a bit. But in the case here, their all-in sustaining cost to produce silver is only $11.50 an ounce. So you've got $25 silver right now. But what I find very interesting is you also have cash costs. Cash costs are not as meaningful, but because you have to pay all of your different, sustaining costs that are there, the cash cost for Silvercorp to produce an ounce of silver is minus $1. So it's just very cheap. And you're going to see SVM have a lot of leverage to the silver price. Silvercorp is it's very undercovered. And I think that once silver heats up, this thing is really going to start to reset. But their earnings are going to drive the stock price. It's, it's under $3 right now. It's been as high as $9. I don't see why it can't go back there in the next couple of years, especially with silver. If you believe silver is going to go and be sustainable and over $30.
The last one you're looking at is, I think you've mentioned before, a little bit of a tiddler. So high risk, potentially high reward, maybe more upside than the others, but comes with those risks.
I own all of these stocks, or in the case of, Equinox, I own stock, but I actually they have a lot of very long dated call leaps that I've purchased for January 2025 and January 26 at the $5 strike price level. I-80, I am still very actively buying this stock. I do not have the position that I want. I would like it to be, well over 100,000 shares. I'm not quite there yet. The Silvercorp is also one that I'm still buying. But this one, Silver Storm Mining, is a rebranded name recently from the historical company was called Golden Tag Resources. GOG was the main symbol in Canada. Silver Storm is SVRS in Canada. Add an F to that for the U.S. component it trades. And I'll just give you a very brief overview on this deal. I got in this one a bit soon. So if you go back 1 year, approximately 1 year, the stock was halted as Golden Tang because they had announced a transaction to buy the first ever silver mine in the history of First Majestic. Keith Neumeyer, one of the best operators, I think, also out there in the silver side of the business. First Majestic, multi-billion-dollar public company. This is in Mexico. It has been their forte, and it's in an area. They've got 2 assets. This is Silver Storm now in the same district, which is very, very mining friendly. But First Majestic, their first silver mine was called La Parilla. La Parilla ended up, I believe that the overall amount of silver that was produced was like over 30 million ounces of silver. And a couple of years ago, they put it on care and maintenance. It's a nice grade asset, and the mine complex is very new and it's worth a lot of money. I believe they've put in over $125 million US into building out the La Parilla mine complex. They put it on care and maintenance because these guys are massively diversifying into gold. They're trying to start the Jarrett Canyon mine in Nevada, which is going to be 400,000 ounces of gold a year, which is a monster. So if you're talking about producing, 2 to 5 million ounces of silver a year for First Majestic, it just isn't going to move the needle very much. But for an advanced asset developer / about to be producer, I think Silver Storm stole this asset from First Majestic. The way that they structured that deal, so the stock was halted at 25 cents, and it was basically halted for about 6 months. And what the deal was is that First Majestic also put up 3.2 million US in, it was supposed to be right around a $10 million Canadian financing at 20 cents Canadian. They wanted to make sure that at the time Golden Tag had the funds to move this thing forward. There's a lot of silver around the complex. So exploration, drilling to enhance and replenish the actual silver that can be mined is what they're doing right now. They've been coming out, Golden Tag, aka Silver Storm, has been coming out with really strong intercepts of drilling that they're already doing in Mexico. So during that 6-month period when they were trying to raise this money at 20 cents, First Majestic was the lead investor. A lot of the purchase price for La Paria, which was something in like the 30 millions Canadian total, which is, we're talking about like an 80% discount to the cost put in just to the complex over time from First Majestic. But they obviously didn't want to let it go. So they wanted a stake in Silver Storm. They are the largest shareholder in Silver Storm. So you're talking about a nice 30% discount to where First Majestic sold them this what will be a mine. It's not going to cost a lot to put it back in production either. We're talking about $5, $6, $7 million. And they're first, though, what I like about it, and they've got cash. They've got several million in cash. They're going to be drilling out and rebuilding the actual resource that can be mined before they try to become and will become an actual miner. Eric Sprott is a 10% holder in the company with a higher cost average. I have a higher cost average because I had been buying it. I went into the 20-cent placement. It came all the way down to 9 cents. And just recently, after the rebrand and everything else, they've come back a bit in the share price. However, it's extremely cheap because before the La Paria acquisition, this company owned their flagship asset is called San Diego. It has $2.5 billion of in situ silver in the resource categories, which means that they've got, it's somewhere in the ballpark of 200 million ounces plus of silver that they've already proven up in the 43-101 process. So San Diego's got, a massive amount of silver there in the ground. And, that's $5 billion worth of silver. This thing is a restart, rebrand, and it just has a very, very streamlined, in my opinion, with any sort of bid in this market. The way that I've couched it with my investors, I think there will be an opportunity to take half of your investment off at a double in 2024, and then just let the rest ride, because who knows where it'll go in a bullish silver environment.
To summarize that stock, what are the sort of, 4 or 5 key points that you really like about it if you were nailing them down?
Most stocks are recommended as either large cap producers, or many of them are early stage exploration companies. Silver Storm is in the middle because they have 2 flagship assets that are very, very advanced in this, and it's a pure play in silver. So the La Paria mine complex that they ended up purchasing for a highly discounted price from First Majestic that they closed earlier this year, where $125 million US has gone into that mining complex, was the first mine that First Majestic ever came out with, and had been profitable for the duration of its active years. Won't move the needle for a company the size of First Majestic, but for Golden Tag could be a very profitable mine that they bought on sale. The value of the entire company is less than a third of just what has been put into the La Paria mine complex. They're already drilling around that complex to replenish resources and reserves to eventually take back out. We've seen press releases to that regard. And their second asset, San Diego, has over $5 billion worth of silver in the ground at good grades and growing. And so it's a very cheap, what I would call developer to be producer, but let's just call it an exploration, late stage exploration development company, which is a nice little sweet spot to have in your portfolio.
I know there might be a drop off of interest from people who are pure mining bugs, but Some of the drivers of the mining space and of the NASDAQ and of crypto are the same thing. So it'd be a little bit remiss if we didn't actually talk about something from the crypto space. Can you just name, you said there's one stock you're looking at also as a sort of a starter for 10.
I have the Phenom crypto letter as well, phenomcrypto.com. On the crypto side, what I try to do is get people to understand, how do I get crypto exposure by buying a stock instead of buying the actual crypto, which is what they should do. But a lot of them will buy these Bitcoin or Ethereum miners, right? And the problem with that is that you're paying the salaries of the C-suite guys, the listing fees, the overhead costs. You've got to go buy all the equipment, your CapEx, your OpEx, all that stuff just to do one thing, and that is to get the actual crypto. Just go buy the crypto. You don't need to do that. I do not have any interest in owning one crypto mining stock. Just go buy the cryptocurrency. But there are exceptions in the public markets that are crypto related that have unique value propositions. And there are two that I own in size. The one that hasn't moved yet, that is a micro cap. Make no mistake, this is a very small company that I own a lot of stock in. I believe that I'm just under 2 million shares in this play. But my cost average is somewhere right around like break even. I don't have a profit in it yet on paper. I don't have a big loss on it either. But this is a very unique situation. So the company's name is Cypherpunk Holdings. The symbols on this, it's a Canadian-based company. HODL is the Canadian main symbol. On the US side, it's CYFRF. The reason I like this deal, and I've been invested in it since 2020, they're trading at a discount to cash and crypto and investments on their balance sheet. They have 215 Bitcoin on their balance sheet. They have just under 2 million in cash Canadian. That's there as well. And then they have $9 million in investments on their books, which actually I think is worth at least double that based on what I know about the investment. So this is like buying a pseudo venture capital liquid fund in the public market where you can own the best of the best private companies in the world, because their main investment, which was done in February of this year, is they put in 9 million Canadian into Animoca Brands. Animoca Brands is their last post-money valuation, I believe, was approaching $6 billion. They have over 400 portfolio holdings across the Web3 spectrum. I believe they're the largest investor in Web3 globally. It goes from anything from NFTs to DeFi to level 2, technologies on Ethereum to AI, the whole enchilada. The guys that run Cypherpunk, they're very wealthy and they're very smart, and they've been in crypto. Two of the board members I know for sure have been very involved in crypto since 2010. So these guys were so early. Their relationships in this sector, I think, are very, very valuable. It's hard to put a value on that. The CEO, Tony Guja, he has been buying millions of shares of Cypherpunk in the open market. And if you look at the insider transactions, these guys have been buying stock very consistently for the last year. It's the insider ownership is through the roof. They're making new investments in many of these different venture plays. They've been pretty conservative with their filings about writing down some of the value of these investments. They have access to deal flow and opportunities in Web3 digital assets and crypto that are very real, very legit. The stock is super cheap. It's trading at a discount to what they have on the books. This time, they're not going to make the mistake of not telling anybody about the company. They are going to market the story starting now and tell more investors about the story, which is very important for these tiny caps. But pay attention to your buy up to prices. You don't want to go in there and just splash it all in there, but it's a steal.
Pretty well. We've talked in the past about how you build your portfolio. We just talked about some of the things that you look at that are in your portfolio. As you say, you've got to have your framework. you've got to have a means and a methodology for doing all these things, and you've got to have a reason for doing these things, which I think you've explained in the past before as well. So all that is absolutely key. You have these on your book, so everyone should be aware of that. But at least it gives us a flavor of not just why you're doing it, but also what you're looking at and the places that you're currently interested in. So thank you very much for that. And the journey will continue.
Awesome, Roger. Thank you so much. It was a fun conversation.